8 indicators and still no edge? The fix isn't better indicators, it's fewer. Here's the setup.
If your Forex chart has 8 indicators on it and you still feel lost looking at it, you're not underprepared. You're over-decorated. Most retail traders stack indicators looking for safety. The result is the exact opposite. Conflicting signals, slower decisions, no edge. Here's the framework that fixes it. Every indicator answers one of 4 questions. What direction is the market biased? How strong is the move? How big are the swings right now? Is the market trending or just chopping sideways? Trend, momentum, volatility, regime. 4 categories, that's the entire map. 3 RSI-style oscillators on one chart isn't confirmation, it's one signal repeated 3 times. 3 indicators from 3 different categories, that's actual confluence. You'll walk out of this with a working 4-indicator chart you can use on Monday. You'll know the 6 that earn their place, and you'll know the one most retail traders quietly ignore, even though it decides whether your whole strategy works today or doesn't. Let's run the 6. Moving averages. The simplest trend indicator there is. The average of the last N closing prices plotted as a line. The 200 SMA defines long-term bias. Rule of thumb, only consider longs above it, only consider shorts below. The 20 EMA tracks short-term trend, and pullbacks to it inside a larger uptrend are classic entry zones. SMA is smoother, EMA is faster. Use SMA for filters, EMA for timing. RSI, a momentum oscillator bounded between 0 and 100. Above 70 is overbought, below 30 is oversold. Standard period 14. But here's the thing, the mechanical RSI hit 70 sell rule is the least valuable thing RSI does. The signal that actually matters is divergence. Price makes a new high, RSI doesn't. That's waning momentum. That's a warning, not a trigger. MACD, the momentum and trend hybrid, built from a 12 EMA, a 26 EMA, and a 9-period signal line. And you don't need to memorize the math, you need to read the histogram. Rapid expansion means momentum is accelerating. Contraction means momentum is fading even before the crossover prints. Lagging by design, useful as confirmation, terrible in chop. Bollinger Bands, a volatility envelope, a 20 SMA in the middle, 2 standard deviation bands on either side. They expand when volatility rises, contract when it falls. The squeeze is the signal. When the bands compress to multi-month lows, a directional move usually follows. You're not predicting direction, you're predicting that the quiet ends. That's 4. The last 2 don't go on the chart the same way. They live behind it. ATR, average true range, measures the average size of recent price moves. It says nothing about direction. It says how big the swings are, and that's exactly why it matters. Stop placement at 1.5 to 2 times ATR captures normal market noise without getting tagged out by routine moves. Position sizing scaled inversely to ATR keeps your risk constant whether you're trading a 50 pip range pair or a 200 pip range one. Trading without ATR isn't risk management, it's guessing. And then there's ADX. Remember the indicator most retail traders ignore? This is it. ADX measures trend strength on a 0 to 100 scale. Above 25, you're in a trending market. Trend following strategies work. Below 20, you're in chop. Mean reversion strategies work. That single distinction is, in practical terms, the most important call a Forex trader makes in a session. Because running a trend following strategy in a choppy market is how accounts die slowly. And running mean reversion in a strong trend is how accounts die quickly. ADX doesn't tell you what to buy, it tells you which strategy is even allowed to fire today. That's the underrated one. That's why it earns its spot. So put it together. Here's a chart you can run on Monday. 5 layers. The 200 SMA, your long-term filter. The 20 EMA, your short-term pullback reference. RSI on the 14 setting, your momentum and divergence read. ATR on 14, quietly running stop and position size calculations. And then the layer no indicator can replace, support and resistance drawn by hand. Trend covered twice, once long, once short. Momentum covered, volatility covered, structure covered. 4 categories, 1 chart you can actually read in 3 seconds. Notice what's not there. No second oscillator, no stochastic on top of RSI, no Williams %R underneath. 3 oscillators all working in the 0 to 100 zone are measuring the same thing. You've just stacked 1 signal under 3 names. The marginal value of indicator number 5, 6, 7 is typically negative. A useful exercise. Hide everything except price for one full trading session. If you can still read trend, structure, and likely entry zones from price alone, your chart reading is real. If you can't, the problem was never insufficient indicators. It was the chart reading underneath them. Different trading styles change the stack, but not the framework. Scalpers, seconds to minutes, keep it minimal. VWAP for intraday reference, a 5 or 9 EMA for short-term trend and price action. Heavy indicators at scalping speed actively hurt. Decisions happen in seconds, and visual clutter costs you the trade. Day traders run the classic 5-layer stack: 20 EMA, 50 SMA, VWAP, RSI, ATR. Swing traders shift up: 50 SMA and 200 SMA for trend, MACD for momentum confirmation, Bollinger Bands for the volatility regime, RSI for divergence on the higher time frame. Position traders barely use indicators at all: the 200-week SMA, rate differentials, the macro thesis. And one more upgrade. Stop stacking indicators. Stack timeframes. Weekly 200 SMA for long-term bias, daily 50 SMA for medium-term bias, 4-hour ADX as your regime filter, 1-hour 20 EMA with RSI for entry timing. A trade only fires when everything aligns. That's real confluence. 3 timeframes measuring 3 different things, all pointing the same way. 3 momentum oscillators on the same 1-hour chart, all saying overbought, that's one signal in 3 costumes. Here's the path most reliable traders walk. They start with 12 indicators and slowly realize the chart is doing nothing they couldn't do themselves. After a year or two, the structural elements, swing highs and lows, trend channels, session ranges, become readable from price alone. The indicators come off one by one. The chart gets quieter. The decisions get faster. A lot of the steadiest forex traders end up with 2 or 3 indicators they've used the same way for years. Not because indicators don't help, because constantly hopping indicators is a sign of looking for an answer no indicator can give you. If you take one thing from this, take this. Pick one indicator per category. Master the 6 core ones: moving averages, RSI, MACD, Bollinger Bands, ATR, ADX. And don't ignore the quiet one: ADX, sitting under your chart, telling you whether today is a trend day or a chop day. That's the indicator most retail traders skip, and the one that decides whether your strategy was ever going to work in the first place. The chart doesn't need more indicators. It needs fewer, used better.
Pick one per category, master the 6, let ADX decide the regime. Full breakdown linked in the description.